All right, part 3 of the third homework set is, most people will say, probably the trickiest thing that I throw at you in here. Again, this one kind of pulls everything together. There's a lot of different concepts that are all embedded in this one portion of your homework here. This is another one of those I qualify as saying, if you don't get it immediately, that's fine. This is hard because it's tying together a lot of different skills all at once. So that's just the nature of what you're dealing with. So it is hard. So if it feels hard or it looks like it's supposed to be hard, that's the idea. But I'm going to try and step you through it so that you'll see that it's not quite as involved in some ways as you would imagine. There's actually some tips that will make it so this is a much easier trip, so to speak, to get through this. All right, so for each of these, what I'm suggesting is adjusting entry that should have been done, right? They should have booked it, but they didn't. And as a consequence of the company not booking it, everything's wrong, right? Everything is wrong. Your net income, your ending retained earnings balance, and your balance sheet, all wrong. So what we're doing here is saying, how is it wrong? Like, how is it wrong, and where are the errors? And a very important thing to understand is these errors cannot be detected by a trial balance, because again, this is another one of those ideas of an error of omission, something we forgot to do. So in all 5 instances of what we'll look, this is not something that would be otherwise detected except by looking at what you should have booked or had maybe booked in previous periods. Now the first one deals with supplies. Again, so this is your basic deferred expense entry that we've covered in a previous video for this homework set. So supplies remaining at the end of the period are $8,000, and supplies account before adjustment is $20,000. So once again, what am I telling you there? I'm telling you what should be in the asset account after adjustment. So that suggests this is the entry that they should have booked. Right? They should have booked supplies expense debit, supplies credit for $12,000, but they failed to do this. Now, as a consequence, again, everything's wrong. All your 3 basic financial statements are errands, but how are they errands? So again, we're going to phrase everything in terms of over or understated, right? So again, to go over that, overstated just means that it's too large. Understated means it's too small. So the first thing to understand, I'll get rid of some of the lines here, is when you're analyzing what's wrong with the income statement, you always start with the half of the adjusting entry that affects net income. So in this case, that's going to be the expense part. Supplies expense is part of, or should be part of, net income. So think of it this way. If we fail to book this $12,000 expense, what's going to be wrong with your total expenses? Total expenses are going to be what? Too small, right? We're understating your total expenses. So if expenses are too small, what happens to net income? Net income is too large. So we know that net income is going to be overstated as a consequence of not booking this by $12,000. Usually the amount is not in question here. It's usually, that's the easy part. We know it's $12,000, but what's the effect? The impact is it's an overstatement of net income because we understated expense. Now here's where it gets kind of easy. Everything, like every single statement, whatever we just did here, this error is going to follow through and impact all 3 statements. And guess what? It's going to be the same error in terms of amount and direction. In other words, our overstatement net income flows to the statement of retained earnings. So guess what? It becomes an overstatement of ending retained earnings of the same amount. It has to, because we know what happens in net income. It flows to the next statement. What happens to ending retained earnings? It flows to the balance sheet. So we know that generically our total shareholder equity is also overstated, which in this case is going to be represented by a positive $12,000. Shareholder equity in total, in this case specifically retained earnings as a portion of it, is over by $12,000. So we have overstatements in net income, ending retained earnings, and our total shareholder equity all of $12,000. So that's the good news. Once you determine what the impact on net income is, it just flows through everything. Now the last piece of the puzzle is what else is wrong with the balance sheet. We know the balance sheet is always going to have a problem in shareholder equity. It's either going to be too small or too large. In this case, it's too large by $12,000. So the other half of the question is, what other aspect of your balance sheet is impacted, either assets or liabilities? It's one or the other. For the secret to that, you look at the other half of the adjusting entry. In other words, supplies is what kind of account? It's an asset account. So if we failed to take $12,000 out of assets, in this case supplies specifically, our total assets as a consequence of that would be overstated by 12. Now look what happens there. You get a balancing error in the balance sheet. In other words, assets are over by 12, liabilities are fine, shareholder equity is over by 12. So you get 12,000 equals 12,000. So that's just another way of reinforcing why the balance sheet and other statements can't detect this error, because everything looks fine, right? Everything balances out, everything seems mechanically correct, but yet there is in fact an actual error here. So again, there's no way to look at the statements in and of themselves and say, yes, here's where we went wrong. It just doesn't work like that, because again, errors of omission can be the hardest to detect because you failed to do something. So failing to do something is pretty tough to look into because nothing happened. If that was A, dealing with supplies. Now in the case of B, we're going to switch to deferred revenue in this case. So now we're looking at deferred revenue. A was deferred expense, and then B is going to be deferred revenue. So same as the deferred expense, again, we have to pay attention to what is the information set being given. So here, 15,000 of unearned fees have been earned, and the account before adjustment is 24,000. So what is this information set telling us? I'm just telling you that's the amount of the adjusting entry. This is what should be recognized as revenue. No math need be done. Now, if I told you that 9,000 was still unearned, then you have to take 24 minus 9, and you would get 15,000 as well. So here's the adjusting entry that should have been booked. Should have debited the liability account unearned fees. Fees earned should have been credited. So again, always start with the half that impacts that income. So that's going to be the fees earned half. So this is the one that impacts net income. So that in this case means revenues should have gone up by 15 but didn't. So we understate revenues. Well, that's easy. If revenues are understated, then guess what? Net income is also understated, and of course we know the amount, $15,000 right there. Just like what happened before with the supplies expense example, that's going to travel to the retained earnings statement, so that guess what? Ending retained earnings is understated, and of course shareholder equity itself in total is understated by 15. All those three things track out every single time. Now the question is, what's wrong with either assets or liabilities? So in this case, again, what's the other half of the entry? Unearned fees, again, that account is a liability account, so we know there's nothing wrong with assets. What's wrong with liabilities? Well, again, think what we should have done. We should have debited that liability account for 15,000, which would have done what? Reduced it, right? It would be smaller. So that means we know that the liabilities are overstated by 15,000. And of course, look what happened. Assets are fine. Liabilities are over by 15. Shareholder equity is under by 15. So we get a nice balancing argument. So 15 minus 15 equals 0. So again, always balances out when you look at the balance sheet portion of our program here. All right, so next up is dealing with depreciation expense. Again, this one is a deferred expense. We just give you the amount. This was, they should have booked $38,000, so the basic entry is right here. Depreciation expense debit, accumulated depreciation credit. Same as before, focus on the half of this that deals with the income statement. So that's going to be this half, depreciation expense. So same analysis. If expenses are understated by 38,000, then that means total expenses are under. That means that net income will now be, as a consequence, overstated by 38. And the amount is usually the easy part to determine. If that's true, then ending retained earnings is also over by 38, and that's also what's true with ending shareholder equity is going to be over by 38,000. So what's wrong with assets or liabilities? Look to the second half of the entry. Accumulated depreciation. Now remember that 38,000 would have been added to the accumulated depreciation account, but what happens then to the book value of fixed assets? Book value of fixed assets goes down 38, so in other words, it should have been $38,000 smaller, so we can say that our total assets in this case are overstated by 38. So we get over by 38 here, liabilities are fine, shareholder equity is over by 38, so once again we get a balancing statement that can't be detected by anything outright. If you look at this analysis and you compare it to the analysis of A, you'll notice they're the same. Over, over, over here, and that's over as well. Why? Because these are both examples of deferred expenses. So the analysis should be the same. The numbers are different, the accounts involved are different, but the analysis is identical. So it's kind of a proof just to show you, if you analyze another thing in the same class, you'll come up with the same analysis as we saw here. Right, D is dealing with, in this case, this is an accrued expense example. So wages expense unpaid but incurred for the period is 175. In other words, I should have booked 175 to wages expense. and wages payable like you see here. That's the entry they forgot. Oops, got away from me a little bit. So again, same analysis. Focus on the half that deals with the income statements. That's going to be first half. So wages, expense. Same analysis we just did a second ago. If we understate expenses, that means income is overstated by how much? 175. That's the easy part. Which means ending retained earnings is also overstated by 175, and ending shareholder equity in total is over by 175. So what else is wrong? Our assets or liabilities? Well, if you look at the second half here, we're dealing with a payable, so assets are fine, so just forget about them. Liabilities is the issue. Wages payable should have been credited for 175, right? So this credit to 175 didn't happen, so that means our liabilities are understated by 175. Should have been 175 higher. So look at the analysis. Assets, no effect there. Liabilities are under by 175. This is over by 175, so this just all sort of nets out to nothing. So once again, no statement is directly impacted. There's no way to detect it outright. And lastly, we have an example of an accrued revenue and what the impact of that will be. So again, last day of the period, we completed jobs totaling 89,000. Nothing's in the billing system until the next month. So this is what we should have booked. Again, that could also be fees receivable as well as accounts receivable. So AR debit, fees earned credit for 89,000. So again, same as before. Which half of this entry impacts net income? And that is going to be the fees earned part. So we should have added 89,000 to revenues. We did not, so therefore revenues are under. If that's true, that means net income is also understated by 89,000. If that's true, that's going to carry over to the next statement, retained earnings. So retained earnings is under as well by 89, and so of course is true of your shareholder equity, also under by 89. So once again, what's wrong with either assets or liabilities? What's the other half of the entry? A receivable. All receivables are part of your asset section, so our assets should have been increased by 89,000. They were not. So as a consequence, assets are understated by 89. So we get an understatement of 89 here. Liabilities are fine. An understatement of 89 there. So same as before. Everything checks out. It all equals, which is why we can't detect it just by looking at our financial statements. As I said at the beginning of this is a hard concept because it's asking you to take concepts of the adjusting entries. So you have to, that's step one, you got to be able to understand what to do there. And then secondarily is being able to analyze what the impact on those adjusting entries is if we neglected them on all your financial statements. It also helps emphasize the idea that everything you're doing here is what? It's connected, right? All your statements, everything in the system is all connected to everything else. So if you make a mistake in one place, everything is impacted, right? You don't get a free ride because everything balances. It's still wrong, fundamentally speaking. Right, that concludes the third part of this third homework set. So look for the final installment in part 4 next. See you there.